Hello, everybody. Adam Bergman here, tax attorney and founder of IRA Financial. In today's video, the Self-Directed IRA Real Estate Investor Guide. This is a really important video, whether you are a beginner, intermediary, or expert in self-directed IRA investing. This video is going to teach you, really show you everything you need to be a master self-directed IRA real estate investor. And that's a shameless plug for my new book, Mastering the Self-Directed IRA, which will pretty much tell you everything you need to know about how to set up a self-directed IRA, what it is, the advantages, how it works, advanced strategies, explain to you the prohibited transaction rules, UBIT, real estate investment strategies, Roth conversion strategies, how to navigate UBIT, prohibited transaction rules, how to shelter gains from real estate investments in founder stocks, investments in almost anything. And if you're looking for a really easy, simple resource, super short chapter, so not going to put you to sleep, 3 to 5 pages, you can put the book down, use it as a resource, probably get through it in like 3 hours. So super easy to read. And it took me about 3 years to write, not because I couldn't have written it in a shorter period of time, but I really focused on keeping it short and sweet. And giving you everything you need to know at your fingertips. So super excited. Who am I? You guys know me. I'm Adam, tax lawyer, master's in tax law. I've been practiced law since 2001, but I worked at some of the largest law firms in the world for almost 9 years. And when I started IRA Financial, the goal was to help educate people and provide a cost-effective, easy way to set up self-directed retirement accounts. So this video, I'm trying to keep it as short as possible because I respect everyone's time, especially in the summer. And I'm going to give you everything you're going to need to know to get the basics of a self-directed IRA, what an IRA is, Roth, SEP, simple, and then move into the different ways to buy real estate, why to buy real estate, and then some advanced tax strategies to consider. Please, if you have questions, don't hesitate. Let me know. Happy to answer any questions on any topic involving self-directed IRAs. It doesn't have to even be real estate. So self-directed IRAs were created in 1974 by IRA. The word self-directed IRA is not in the tax code. I'm not going to find it. Why the IRS did not distinguish, and Congress did not distinguish between an IRA that invested in traditional and an IRA that invested in alts, like real estate. Okay. There's only 3 things you can't do with an IRA. I'll get to that in a few minutes, but just a sneak preview. Can't buy life insurance, can't buy collectibles, and you can't engage in any transaction with a disqualified person involving your IRA. And a disqualified person is defined as you, your lineal descendants, your parents, children, spouse, daughter-in-law, son-in-law, or any entities controlled by such persons, 50% or more. Otherwise, you can do it. So gives you a almost unlimited investment opportunity. And said this before, I'll say it again, there's almost nothing more American than having freedom in your retirement account, being able to control your destiny, control your investment future. Don't need to blame a financial advisor or an investment advisor why your account went down. No, it's on you. You get to self-direct. You get to control your future. You get to invest in almost anything you want, which is the most beautiful aspect of the self-directed IRA. So just quick, some basic info on IRAs. Any type of IRA can do a self-directed IRA, even a Coverdale or HSA. Just quick, traditional IRA, it's a pre-tax IRA. You get a deduction for putting the money in. Once you're 59 and up and you pull the money out, subject to income tax. If you're under the age of 59 and a half, it's income tax and a 10% penalty. Once you're over 73, you have to take RMDs, required minimum distributions. Roth IRA, created in 1997 by Senator Roth, is the opposite. No tax deduction, but once you're over 59 and a half and the Roth has been open at least 5 years, it's all tax-free, which is why I'm a huge Rother. I wrote a book, In God We Trust and Roth We Prosper. All my retirement accounts are in Roth because I love tax deductions, don't get me wrong. Any tax lawyer does, but in the retirement world, because there's such a large runway ahead of us, IRAs are long-term investment strategies. So for me, I feel I'm going to generate a lot more tax-free growth than a deduction on an IRA contribution. So if you're in a 30% tax bracket and you put $7,000 in a traditional IRA, that's giving you a $2,100 net tax deduction. That's good. Nothing wrong with that. But I believe I can do better over the next 20 or 30 or 40 years in sheltering income from tax. The SEP IRA is established by business. It's a profit sharing plan. If you're a sole proprietor, single member LLC, 20% of your Schedule C up to 69K. If you're a C Corp, S Corp partnership, 25% of the W-2, not the income of the business, the W-2 up to 69K. No catch up like a solo 401k. And you can now do contributions in pre-tax or Roth. And then the SIPL is a mini 401k plan. So let's talk about the different types of self-directed IRAs. I think this is the best way to understand them. So the most common way to buy real estate in an IRA is just a full service. I call self-directed IRA. Why is it full service? Because the custodian is more involved. If you need to make the investment, the custodian makes the investment into the IRA. Title in the IRA is made in the name of the custodian for your benefit. So for example, IRA Financial Trust Company for the benefit of the Adam Bergman IRA. So that's why I call it full service. If you want to pay expenses, the custodian has to be involved to cut that check, because the custodian for your benefit is the title holder and trustee of that investment. Full service self-directed IRAs are great if you're doing passive investments like investment funds, private equity, hedge funds, credit funds, real estate funds, investing in private businesses, even cryptos on our great platform with Bitstamp and Robinhood. But if you want to do something more active, when I say active, I mean something where there'll be more transaction orientation, a higher frequency of transaction, the self-directed IRA LLC checkbook control. I basically wrote the book on it. I've been doing the checkbook controls almost 15 years. When a lot of other custodians are like, you can't do it, it's so risky. I'm like, no, I'm a tax lawyer. I know what you can and cannot do. I understand tax court, field service advisory opinions. This has been blessed by the IRS and the tax court since 1996. In fact, on the partnership return, it asks you whether the owner of the partnership is an IRA. Okay, so anyone that says, oh, you can't do an IRA-owned LLC, I'm like, well, the 1065 asks if the owner of the partnership is an IRA. On top of that, if you want to get a loan by Freddie or Fannie, you have to use an entity. You can't not use an entity. So the beauty of the checkbook control, it's very similar to the full service, right? Here's the full service. The only difference is an LLC, a limited liability company, is entrenched between the custodian and the actual investment. What does that do? Number one, gives you limited liability protection, meaning all your assets outside of the LLC are protected from credit attack. Number two, the investment is titled in the name of the LLC, not IRA Financial Trust Company for the benefit of Adam Bergman's IRA. So that gives you privacy, right? You also have what's called checkbook control, which gives you freedom, meaning you got to pay a contractor, you got to pay the plumber, you got to pay taxes, you got to hire an accountant, a lawyer. You can write the check as the manager of the LLC. So this is a manager-managed LLC. The LLC could be wholly owned by an IRA. It could be owned by multiple IRAs or owned by IRAs and individuals. And we'll get into that in a few minutes with the prohibited transaction rules. But very, very, very popular for real estate. Why? When you're doing real estate, assuming you're not investing in a passive fund, there's going to be times where there are going to need to be certain actions, right? Like writing a check to complete a task, like paying a landscaper. You may need access to like Venmo or Zelle or a bank account to get things done. You can do that in the LLC much, much easier than doing it with the full service, because with the full service, yeah, you can go in our app and it's pretty quick, and then we'll issue a check to the contractor or to the accountant or the IRS. But if you do it with the LLC, you have the control. The power gets shifted from the custodian to you as the manager of the LLC, and that's where the term checkbook control comes in. You can call it wire control, Zelle control, Venmo control. I don't care what the name is. The word checkbook control is a made-up term. Again, you're not going to see that terminology in the tax code. You're not going to see the words IRA LLC or full service. These are just terms that are made up. You can call it the Adam Bergman IRA LLC. It doesn't matter. What it matters and what the important aspect of this solution is that an LLC is superimposed right here between the custodian and the investment. giving you more freedom, control, limited liability protection, and of course, privacy. So if you're doing real estate flips, real estate development, Airbnb, you want limited liability protection, you want control, freedom, privacy, the LLC is the most popular option. So I assume you are watching this video and you understand the powers of real estate, right? And I'll talk about why some people want to buy real estate and then get into the tax reasons, which is what I can really talk to. I mean, I own real estate outside an IRA and inside an IRA, and I'm a big believer of the asset class. Great rate of return, right? It's been the S&P 500 over the last 10 years. Hard asset, you feel safe. Hey, I know I own a bunch of real estate, and if the market drops like it did on Monday, 1,000 points, I'm not stressed because guess what? The tenant is paying me the rent every month anyways. I'm not worried. I have two sources of income. I get rent, cash flow, and I got asset appreciation if I sell the asset, okay? I have diversification, right? It's important to diversify. I'm a tax lawyer, so I'm not going to give people investment advice, but what works well for me is diversification, meaning you have some money in stocks, ETFs, mutual funds, gold, and real estate, or private equity, private investment funds, private businesses, even gold, even cryptos. You want to have diversification. You don't want to put all your assets into one asset. I think real estate, if you're going to move out of the equities world, real estate is, to me, the first stop because it's a hard asset. We all know it. It's easy to understand. It's pretty liquid. Not as liquid as selling a stock, but there's always a marketplace for it. And you have two sources of income, cash flow, and asset appreciation. But why should you buy it in an IRA? Well, as you guessed it, there's a tax reason. In general, when you have real estate in an IRA and you generate income and gains, the income is not subject to tax. It goes back into the IRA without tax. That's now known as deferral or compounding returns. If you sell the real estate asset, there is no tax. There's no ordinary income tax. There's no capital gains tax. You don't have to worry about any tax. The power of 72, meaning if you average a 9% rate of return, your money will double every 8 years. That's the power of 72. The best way to take advantage of the power of compounding returns is the retirement system, specifically the Roth IRA. Other than life insurance, it's really the only product where you can compound your returns. What does compounding returns mean? It means your money is going to grow faster when it's not subject to taxation. So other than life insurance and IRAs, Roth IRAs, there's really no other vehicle that's going to allow you to fully enrich your experience and take advantage of compounding returns. Compounding returns has been called the eighth wonder of the world, not by me, but by individuals way smarter than me, like Albert Einstein, Warren Buffett. This is how rich people get richer. Wealthy get wealthier through the power of compounding returns. That's why owning real estate in a self-directed IRA is so valuable. Not only do you get diversification, get to invest in assets you know and trust, you have hard assets, hedge against inflation, you also have very, 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 very strong tax benefits. So I talked about the prohibited transactions. I'm not going to spend a lot of time on it. I've done a lot of videos, podcasts, blogs on it. You can always read my new book, shameless plug, to learn everything you need to know about prohibited transactions. But essentially 3 things you can't buy: life insurance, collectibles like art, and any transactions involving a disqualified person, which is you as the IRA owner, your lineal descendants, your parents, your children, spouse, daughter-in-law, son-in-law, or any entities 50% or more controlled by such persons. Of note, brothers, sisters, aunts, uncles, cousins, friends are not deemed disqualified. They are good to go. So when it comes to real estate, here are some important tips to keep in mind, right? You basically can't provide services, active services to your IRA-owned real estate. So of course, you can decide what the IRA is going to buy, the price. You can pick the realtor, the lawyer, the accountant. You can decide, hey, I want the color of the walls to be white or yellow or brown. Of course, you can make those decisions. You shouldn't do anything active, right? Just like you can decide if your IRA is going to buy Tesla or Apple, you can decide which house to buy and what you're going to sell it for, what you're going to rent it out, or even who your tenant will be. That's basically where your role should stop. You should be a passive investor, not active. You shouldn't be fixing the toilets. You shouldn't be painting the walls, mowing the lawn, fixing the sink if it's a problem. You should be using non-disqualified third people like contractors or handymen to do all that work. So you don't want to have any personal involvement at all, okay, other than passive business decisions. And just when you think about the prohibited transaction rules, the most important thing to remember is this. If your IRA makes the investment, it must be done to 100% exclusively benefit your IRA. So there can't be any personal benefit. So if you buy a house with your IRA and live in it, obviously that's a personal benefit. If your son and daughter lives in it, that's a personal benefit because they're a disqualified person, right? So it's basically the IRS is saying, hey, use your IRA to grow your IRA. Use your IRA to benefit your IRA long-term as a retirement plan vehicle. But if you're going to get any personal benefit from it, just pay the tax and take a distribution. Don't use your IRA to personally enrich yourself or a lineal descendant, which the IRS feels is kind of you, right? Your kids are kind of you. Your parents are kind of you. So just got to keep that in mind. Real estate's usually very simple. There's not a lot of risk for prohibited transactions. As long as you're not going to rent it to a lineal descendant, sell it to a lineal descendant, buy it to a lineal descendant or any entities you control, don't do any active work. Most of my clients are like, I don't want to do the work, Adam. I don't want to fix the toilet. So don't worry. I'm going to pay someone to do it. You're okay. Now, joint ventures is a very interesting topic. And that is a topic for probably the next, maybe I'll do it on the next YouTube Live. So a joint venture is a investment venture between two parties. But what I'm getting at here is a venture between an IRA and an individual, let's say a disqualified person. So let's say my IRA wants to invest and I have 100 grand in my IRA and I also have 100 grand personally and I want to buy something for $200,000. Now I have options. Now, clearly it's safer and easier and cleaner if I just used IRA money. Number two, you can use a non-recourse loan. What's a non-recourse loan? It's a loan you do not personally guarantee. Why? 4975C does not allow you to personally guarantee an obligation of your IRA. That's why it has to be non-recourse. Thirdly, you could do a joint venture with a non-disqualified person, right? Friend, brother, sister, aunt, uncle, cousin, neighbor. But fourth, can you do a joint venture between your IRA and you personally? So it's a gray area. And if you look at the Swanson case, which is a 1996 tax court case, the Swanson case said this. It said, an entity only becomes disqualified once it is funded. So if you just set up an entity with the Secretary of State, it's not disqualified at that point. There's no money in it. It's not funded. It's a nothing. It's an invisible nothing. Once it gets funded with IRA money, then the prohibited transaction rules start tolling and start applying. So the concept is this. If you set up a new entity and then your IRA and then you, let's say, are a disqualified person, jointly fund simultaneously the same day, and then don't add any more money after, don't take any personal benefit. All distributions go pro rata, all gains go pro rata, all losses go pro rata. Pro rata means based off interest in the LLC, ownership percentage. Then there's no additional prohibited transaction that occurred. So based off Swanson, since an entity only becomes disqualified once it's funded, you funded it. So now it's disqualified. But if there's no other activity that can trigger a prohibited transaction after that entity is funded, it's seemingly okay. So it's obviously more gray than if you just did an IRA joint venture with a random third party that's not related to you. There's no risk, right? Anytime you have a disqualified person involved in an IRA transaction, there's always a sliver of risk. The question is, how big is that risk? If you follow the components of Swanson and you fund and then don't add any more money and kind of just let that vehicle go and just sit back and passively allocate the income to the owner's pro rata, you're going to be okay. The issue is if you do an action or activity that could potentially trigger a prohibited transaction after the fact, after that entity has been funded, there you potentially get into some trouble. So again, another reason it's super important to work with a company, whether it's IRA Financial or another self-directed company, someone who has experience, expertise, pedigree in the space, someone who understands the rules, the cases, IRS rulings, that can help you navigate the rules, keep your IRS safe. We've been voted by Investopedia as the best company in the space for audit protection. And it's because we're the experts, right? None of our clients get audited. We don't let clients do anything shady, okay? We're going to make sure that they're going to do everything within the confines of the rules, which I think is what really separates us, along with our flat fee pricing and our technology. So let's talk about some tips for avoiding a prohibited transaction. As I mentioned, just stay passive. If you're going to do things with a disqualified person, talk to us if you're working with us. We want to keep in mind Swanson, some other cases that can give you some, at least, tips in terms of navigating rules. Don't take fees for services. Don't take fees for managing investments. You can have third parties do it, non-lineal, like brothers, sisters, aunts, uncle, cousins, friends. Use other people, third party, to do all the work. You basically should just sit back, have a coffee and just watch your investment grow, right? You should be obviously picking what you want to buy, what you want to sell, who the tenant is. You can decide, hey, I want the TV to be on this wall or that wall. Like, you have the ability to make passive decisions. Don't hang the TV yourself. Don't fix the cabinets. Just have third parties do it. But I also wouldn't do active marketing. Like, just have a third party do the marketing of the space for you. If you are doing something active, then just make sure you're not charging fees or services, or really staying as passive as possible. If you're a disqualified person, don't be the realtor. You can use a real estate agency you're involved with, but don't take any commissions. Don't take any fees or services. Just be smart. It's not worth risking the investment for a couple $1,000 for some fees or services. Just have a third party deal. Okay, UBTI and UDFI, you've heard me talk about the 4-letter word. This does come up in real estate, probably more so than any other investment. In general, most categories of passive income generated by self-directed IRA is not subject to tax, right? Interest, dividends, royalties, rental income. Okay, capital gains. So let me pause at rental income and capital gains. If you do a real estate investment and you're using cash, no leverage, no loan, okay, and it's a passive investment, you're not investing in a real estate business, you will have no UBIT. Okay, so we can move on to the next slide. You're good to go. Don't have to stress. But if you're going to invest in a real estate project, whether it's a single family home, multifamily, or even a real estate fund, and there is going to be leverage used, meaning there'll be a loan. Number one, got to make sure the loan is non-recourse. Can't personally guarantee it. Number two, got to think about UBIT. Okay, unrelated business income tax. It's a tax that's put in the code back in the 50s. It really shouldn't apply to IRAs. If I ran for president, I would strip it out of the code and would not apply it to IRAs. The problem why it applies to IRAs, because IRAs and 401ks are treated as tax-exempt 501 trusts. Yeah, they're not 501c3s, but IRAs and 401ks don't pay tax, right? That's why we're here together learning about self-directed IRAs and real estate, because there's no income and tax in general when you own real estate in an IRA. But the UBIT is the one exception, and something called unrelated debt finance income in section 514. And how does it get triggered? Well, acquisition indebtedness. So here's a simple example. I put $100,000 in my IRA to buy real estate. Okay. And sorry about the internet. I see it's like kind of a little bit buffing. Sorry about that. Not sure why. We're actually moving offices next week. So hopefully to a bigger, newer, nicer office in Miami. So hopefully the internet will also be better, but my apologies on that. But 514 UDFI. So example, I put $100,000 in my IRA to buy real estate, but I'm short. I need some extra money. None of my friends want to lend me money. I don't have any personal money. I go to a bank and they say, okay, we'll lend you another $100,000 to buy the real estate. I say, okay, the loan has to be non-recourse. I said, no problem. We're going to have to charge you a little bit more in interest, and we're going to require you put down at least 30 to 35%, because as a lender, we're taking greater risk. I said, no problem. I got $100,000. I'm putting 50% down. I said, okay. Now, let's say I buy the asset and the asset generates $10,000 in net income. When I say net income, I mean after depreciation, after loan servicing, other expenses. For example purposes, let's assume $10,000 net comes in. So because I use 50% of the acquisition price in debt, that means 50% of the $10,000 or $5,000 would be subject to this UBIT tax. And the UBIT tax follows the trust tax rates, which in 2024 can go as high as 37%. Now, the additional problem with the UBIT tax rate is that 37% tax gets triggered at a very, very low threshold, approximately $15,000. Okay. So that's why I'm saying for real estate, what you have to be aware of. And again, another reason to work with a company like IRA Financial, because we will spot these issues for you. So you say, yeah, I'm going to use leverage. We'd say, okay, let's do the math. Let's see, what do you expect to take in income? The one thing to also note with UBIT is you can reduce your UBIT by losses. What are losses, right? A lot of real estate projects have losses in the beginning years because there's a lot of debt servicing, a lot of depreciation. So you can carry those losses forward. And we're one of the few companies in the space that also filed a 990T, which is the form you file to report UBIT. So you can use losses to offset UBIT. Okay. If you have less than $1,000, there's no UBIT tax return, no tax. So we will help you. Some clients like to file the 990T to lock in the losses. It's questionable whether you even have to do that. You just need to have record of those year-end losses so you can carry them forward to offset future gains and reduce your UBIT tax. So just to come back to UBIT, it's a very peculiar tax because a lot of people just don't get it. And I'm with you. It shouldn't apply to IRAs. That's why it's confusing. But remember, it only gets triggered in a real estate world if your real estate asset is involving leverage and there's more than $1,000 of net income for that year, or if your real estate asset investment is involving a real estate business, like a project involving developing 100 homes. That's going to be deemed a business more than a passive investment. So that's where you have to be aware of the UBIT tax. And this is where we come in because we have solutions. Yes, we can come up with ways to eliminate it, set you up with a solo 401k if you're self-employed. A solo 401k is exempt from the UBIT tax under 514c9. C Corp blocker can reduce your 37% to 21%. We would help you run the numbers to make sure that makes sense. A loan versus an equity investment could eliminate the UBIT too. So we have different ways to help you. Okay. And that's, again, another reason we're the best in the space, especially when it comes to real estate, because we've been doing it a long time and we have the expertise. And my team, we train every week. Okay. We work every week on getting better, smarter, and making sure the whole team, not just me, we have 75 plus amazing team members at IRA Financial, and we focus on training to make sure that all our clients get all the correct information so all of you could tax optimize your transactions and take advantage of the amazing tax benefits of using a self-directed IRA. So I talked about C Corp or REIT and even potential debt versus equity investments. Roth conversions. This is another advanced topic. I have a whole chapter in my book, selfless plug again, or shameless plug, not selfless, shameless plug. But Roth conversions are very cool because when assets depreciate, like this week in the stock market, right? Your Tesla is down like 19% or so. I have a lot of Tesla stock. I believe in the company. Even Nike's down like 37% this year. It's a great time to do Roth conversion. Why? Because you're going to convert at a lower price. Yes, you have to pay ordinary income tax on that value, but once it's in a Roth, so long as you're over 59 and a half and the Roth's been open 5 years, it's all tax-free. So Roth conversions could end up saving you thousands, if not hundreds of thousands of dollars in future tax if you convert at the right time. Same applies to real estate. Pushback in the market. real estate prices drop 10, 15, 20, 30%. God forbid, right? We don't want that to happen. But if it happens, you should always say, you know what, this isn't good. But in the IRA world, so long as you're not in your 70s and you need liquidity to live, you should be looking at pullbacks in the market as opportunities. That's what I did this week. I saw pullbacks. I said, I still believe in the US economy. I'm super bullish on the economy. Still the greatest country in the world. We have an amazing number of companies. Our growth in AI and technology is unmatched in the world. There's an amazing flow of capital coming to this country. This is where people want to live. No one wants to live in Russia or China or Iran. People want to live in America. So I'm bullish. I don't care who the president is. I'm bullish in this country. And I'm a long-term thinker. I have all my money in my retirement accounts. So I look at downturns and I say, I'm going to keep converting. Now, I've converted everything I could already, but this time I actually I'm finishing up my spouse's conversions. And I said, let's do this. She has some equities. I said, this week, let's convert. And we did that. So look, as a retirement account investor, it's important to look long-term. Look where your account will be, not today, where it's going to be in 10, 15, 20 years. If there's a drawback in the market, look at it as an opportunity. Conversions are a really exciting way to take an asset that could be subject to tax once you pull it out after 59.5 and literally shelter the asset from taxation. It's crazy. Like you can literally shelter all future income and gains from tax. Again, I wrote a book on it, and God We Trust and Wealth We Prosper. There's so much information. I've written tons of blogs and done podcasts and videos. It's an area that doesn't get enough focus. Why? Because people look in a market pushback and say, oh my God, my IRA, my 401k is down X percent. No, you should be saying, that's okay. I'm only in my 40s or 50s. I can't take the money out for 10 or 20 years. I love it. I look at drawbacks and I'm excited because I see value. I see opportunities, purchasing power. Same with real estate. I have a client, I've told the story. He's passed on, but I met him when I started this company in 2009. He was one of my first clients. Smart guy, lived in the South. He would buy up small, like depleted homes, and he would end up renting them out at pretty good rates. So he'd buy homes for like 30, 40, 50 grand, spend a little bit fixing up. And he was getting like $700-800 a month. It's just like unbelievable. And when the market, he owned everything pre-tax. And then when the market crashed, he started converting in 2009, 10, and 11, turned his whole portfolio into homes. He ended up owning like almost 50 homes across the South, all in Roth. And now his family, he passed on, his family lives off that money, tax-free. And I actually know, his wife, his kids, like they're living off that money tax-free. The kids have 10 years to pull it out tax-free, but his spouse still has it. And his spouse is still alive. So his spouse is literally living off this money tax-free. And he was just such a smart guy. Like he never, I don't think he went to college. He was just one of the smartest investors you'll ever meet because he was a long-term thinker. He's like, I'm going to own these homes. These homes are going to be a legacy for my family. I'm going to be able to use the income to help me live when I'm older. And unfortunately, he passed away pretty young in his 70s. He had cancer. But his family's living off the cash. And he was just very, very thoughtful and just considerate of his buying power. And anytime he had some extra money, he would just buy another home. And over the years, he built up a really nice portfolio of homes. His family's, wealthy family for just one person, right? I always say, if you look around your family and you're like, who's the legacy holder in our family? Who's the millionaire in our family? And you can't find that person, then it should be you. You can do it. The retirement system will let you do it. It won't happen tomorrow. But as you get older, and I'm almost 50, like I see it. Time flies, right? I look back when I'm in my 30s and I'm like, oh my God, if I did more now, like 15, 18 years later, I would have like 4 times the amount of that money. So the long-term thinkers always win. The short-term thinkers always lose. So if there is a market drawdown in real estate, and there could be, right? Who knows where the economy is going? You could, say, darn, but look at it as an opportunity, especially if you have an IRA, pre-tax IRA or 401k that owns real estate. think conversion. Yes, you have to pay income tax on the amount you convert, but if you can pay that tax, so long as you're 59 and the Roth's been open 5 years, you can pull that money out tax-free. The income and gains will just keep growing tax-free, and you'll take advantage of compounded returns. Who should do a conversion? There's no right or wrong answer. I know you hate that answer, and it's like such a lawyer answer, but it's the truth. Why? There's a bunch of factors you have to take into account. Number one, can you pay the tax? If you have the best strategy, but you can't pay the conversion tax, ain't going to help you. Maybe you have losses to offset the gain. What's your age? Someone who's 92, less likely to convert someone who's 32. Now, I do have clients in their 70s and 80s that are converting because they have a low income or they have some losses, and they're going to convert and then leave that Roth as a legacy to their spouse, kids, grandkids, so they can just have tax-free income. So, are you a good investor, right? Like, you think you're going to hit a home run with this money? Are you a lousy investor and just going to convert and lose all your money? That's not good. So what's your income bracket going to be when you're retired? Is it going to be high or low? If it's low, maybe a conversion doesn't make as much sense. If it's high, probably makes a lot more sense. So very, very interesting and very, I think, tax efficient and tax advantageous strategies. Not enough people take advantage of it. So if there is drawdowns in the market, look at it as a potential favorable opportunity. I talked about joint ventures. As I mentioned, the only time you have to really think is if you're going to do a joint venture with a disqualified person. Remember my discussion on Swanson. You fund it simultaneously. Do not add any more money from your IRA or personal, and just kind of leave that as a closed-end investment, right? Don't add anything. Yeah, other investors can come in non-related. You can do leverage on it, but you or your IRA should not add any more money to it. Consider it like a closed-end investment. Otherwise, you can do joint ventures with friends, aunts, uncles, cousins, brothers, no problem. If you're using a leverage, a loan, make sure it's a non-recourse loan, and we have non-recourse partners that you can work with. So this is the last slide, probably the most important thing I'm going to talk about. Before buying real estate in a self-directed IRA, this is what you have to remember. First of all, obviously, like any investment you do, personally or in an IRA, does the investment make sense, right? Does it work? Do your diligence, right? What are you buying? Where are you buying it? Is the rate of return good enough? Is the rate on the cash invested good enough, right? Does it make sense? Is this a good investment? Do your diligence. Number two, is this going to be prohibited? Am I buying it from a disqualified person? Am I going to sell it to a disqualified person? Am I renting it to a disqualified person? What am I doing here? So got to consider that. Third, what structure am I using? Am I going to do a full service, or do I want to use an IRA LLC? There's also an option of using a trust. Instead of an LLC, you have a trust. You save the entity fee, and you also can potentially get around something called the BOI, the Beneficial Ownership Interest, Corporate Transparency Act filing, which is due by the end of the year for existing entities, which you'll be receiving information from us. That's something that you need to do if you have an existing IRA LLC or a 401k that owns an LLC. $10,000 penalties, jail time up to 2 years. So we'll be communicating with you. We do that for you, so don't worry. But you want to choose what solution structure you're going to use. Then, is there going to be UBIT, right? Are you using leverage? Are you investing in a real estate business? If not, don't worry about UBIT. You're good to go. And then, is there a Roth conversion opportunity? Once you own that property, there's a drawdown on the market and you have losses you want to offset, a low income year. You just feel like this is a great opportunity to convert. You can do it. Now, you don't have to convert the whole asset at a time. You can convert percentages. Whether it's owned by an LLC or full service, we can do partial conversions for you. So you can say, okay, I have a $300,000 real estate asset. I think it's going to be worth $600,000 in 10 years. I'll convert, 30 grand for 10 years, and I'll pay the tax. And you can pay the income tax bracket, right? You can look and say, okay, I'm in the 24% tax bracket. There's another 60,000 before I get to the 32% tax bracket. I'll take that income. I can pay the tax, but it's not going to push me into a new tax bracket. So I'll keep doing that over a bunch of years, and ultimately over 5, 10, 15 years, the asset will be fully converted. So you have flexibility. We work with you. We will help you. Just talk to us. We want to hear from you. And that's, again, the advantage of IRA Financial. We're not just going to set you up with a self-directed IRA and say, okay, you're on your own. We can't help you, go hire a lawyer. No, I hate when people say that. No, we're going to work with you. I am a lawyer. That's what my competitors say. They're like, we can't answer it. Go hire a lawyer. Why? Because they don't have the expertise. They can't help you. We can. So, I truly believe we should be working with everyone in the space. Like, yes, I'm not objective at all. I do think IRA Financial is better than everyone else. And I am sensitive. Every time I hear that, I speak to someone, they're like, I didn't know about you guys and I use some other company. And I take that personal. I do. I'm like, we're the best. Why would you do that? And then I usually get them to switch to us anyways, because they realize our fees are like a quarter of the price, flat fees. We don't nickel and dime. And you get to talk to people and we're going to give you the answers to your questions. We don't tell you, go hire a law firm. So what's some trends? I want to end on this. Fractional real estate is still popular. I'm seeing more and more people getting into fix and flips. That kind of died a bit in the last couple of years when prices increased, but prices have pulled down, and a lot of investors are seeing opportunities. Airbnb, vacation real estate are still hot. Multifamily hotels, like motels, are coming back, like smaller hotels. But watch out, there could be UBIT on that, so we'd have to chat and make sure we can structure that investment to be as tax efficient as possible. Real estate credit funds are the most popular. That has exploded over the last couple of years. Why? Because as interest rates go up, these credit funds are pulling 10, 12, 15% returns. But if you do a real estate credit fund with personal money, you're going to pay ordinary income tax. Interest is subject to ordinary income tax. You do it in a self-directed IRA, no tax. So unlike a capital gains investment where you're saving 15% tax, on a credit fund, you could save ultimately 35, 37%. So credit fund investment should be exclusively done in IRAs. And I think we're the leaders in that. So that's a huge trend I've been seeing 23 and 24. Just some info about us. You literally know about us. We literally wrote the book on the self-directed IRA. Shameless plug once again. That's it for today's video. I think the most important slide is this. So before anyone makes a self-directed IRA investment, this is what I would be looking at. Again, do the math, do the numbers. Does this work? This should be an investment for your future. So you really want to take the time. It's not like buying stocks where you can just buy and sell daily. You have to know what you're doing. Is it prohibited? Is there a disqualified person involved? Ask if you don't know. How should you structure it? LLC, full service, maybe a trust. Is there leverage going to be used, non-recourse loan, or is this a real estate business? Just know if you fix and flip like a bunch of homes a year, that's not a business. If you fix and flip 15 homes, maybe that's a business. A business is if you're investing in a real estate development company. It's building homes, like tracts. They have 10 acres of land and building 10 homes. That's a business. If you're doing Airbnb, even multifamily rental units, it's not a business, okay? So it really comes down to leverage. And if there's leverage, we'll find ways to either eliminate it or block it. And then do you have some Roth opportunities to reduce your exposure to tax on future distributions and a future liquidity event and shelter all of it from taxation? A couple questions. Adam, what crypto exchange do you use? So we have a great partnership with Bitstamp, which was just acquired by Robinhood. So our crypto exchange, I'll do a video on it. I think it's the best platform out there for self-directed IRAs. Why? Because our fees. So it's very important to me. I'm a hodler of Bitcoin and Ethereum. I don't sell. So it's upsetting to me. A lot of my competitors, what they do is they charge asset valuation fees. So 1% of your assets, we're going to charge. So if you buy Bitcoin for $50K, that's $500. And if it goes to $100K, now you're paying them $1,000 for nothing. We have a different fee model. And on top of obviously fees they charge you to buy and sell. We have a $100 fee just to keep the account open a year. That's it. We have no asset valuation fees. And then we just obviously have Bitstamp trading fees. But if you hodl, if you're going to buy Bitcoin and leave it there for 10, 15, 20 years, all you're doing is paying us $100 a year. If you use a competitor of mine, you're going to pay them at least $1,000, depending on the value, right? It's 1%. Crazy. So if you don't use our platform and you're a hodler, like it doesn't make economic sense. You're foolish. Sorry for being a little bit abrupt, but it's the truth. So if you should use our platform, if you don't and use an IRA LLC, you can use any platform you want. It's up to you. When wholesaling real estate, aka signing contracts to eliminate UBIT, can IRA own share in a zero tax offshore corp as a blocker to eliminate? Yeah, David, just know if you're using foreign blockers, there's something called FIRPTA. So, just understand the consequences. I don't know what you're doing. If you're flipping contracts, you may be okay. FIRPTA is Foreign Investment and Real Property Trade Act. If you have a foreign company that owns U.S. real estate, there could be withholding tax on the gains. It's tricky, foreign companies owning U.S. real estate. Good for estate planning, but it's in an IRA. Sometimes it doesn't make sense. David, more of an advanced topic. Happy to chat with you about it. If I have a partner who becomes disqualified to me by us being 50-50 in a deal, does that forever disqualify? No, once the deal ends, you're not, once that 50-50 is over, he's not disqualified for you anymore because you don't have that relationship anymore. Do loans to solo 401k need to be secured by deed? No, you can do an unsecured loan. It's up to you. Just obviously it's riskier if you lend people money out of your solo K and it's not secured, just a handshake or a written document with no security. It's your call, right? It's a private loan. You can do whatever you want. You just can't lend the money to a disqualified person. That's the only restriction. That's it for me today. I hope you guys enjoyed the video. This is hopefully everything you need to know about buying real estate and a self-directed IRA. Obviously, this is also important. Just understand the differences between the full service and the LLC. For most real estate folks, most of the real estate investors we work with like the LLCs. Just keep that in mind. And we do it all for you. We literally wrote the book. I wrote this book and I wrote another book, 2 other books on the self-directed IRA, self-directed IRA in a nutshell. And I wrote the checkbook control IRA as well. So I don't think anyone does this better than us. We'll do it all for you. Don't worry. Otherwise, ask questions. The most important thing is structuring upfront. Think about private transaction, think about UBIT, and then ultimately make sure the economics work, right? That's the most important part, is making sure this is a good investment for your IRA. You can do real estate with traditional raw, SEP, simple, Coverdale's, health savings, even solo 401ks. We'll do it all. We're the only company that will work with any type of retirement account, including cash balance, combo plans, defined benefit plans. So we literally wrote the book on this stuff. Hopefully this was informative, educational. And the goal was this video is hopefully suitable for an expert, someone who's a newbie, and someone who's kind of in the middle that understands some concepts, but wanted a broader and more detailed discussion. So that's it. I could talk about this stuff for hours, assuming I don't lose my voice. Sometimes I do. But as you can tell, I love this stuff. Super pumped. It's nothing more exciting to me than helping educate people about the power of the U.S. retirement system. And again, this is up to you. That's the beauty. I'm not here selling products. I'm not selling a home. What I want to do is help educate people, right? If you don't want to buy real estate in your IRA, that's fine. But you should know that it's allowed, right? You should know what your options are. Then it's up to you to decide what you want to do. Maybe you don't like real estate. Maybe you just want stocks, or maybe you just want gold, or maybe you just want private business stock or tax liens or whatever else. I don't care, right? The idea of the self-directed IRA, why it's so dear to my heart, is I'm with my clients, right? We're totally on the same side. I'm not trying to pump you with investments or get commissions, buy this, buy that. No, I'm saying, hey, pay us a small fee every year flat to unlock your money. We'll take care of all the IRS reporting, all the administration. We'll do your consulting. We'll do your tax reporting, tax filing. We'll handle BOI, all filings. So this way you can focus on what you do best, which is investing, and we can focus on what we do best, which is actually keeping your self-directed IRA compliance out of any issues. So yeah, I'm going to, I like the monitor, but I get it. I should have the slides on the screen, but this PowerPoint is available. So if you go on our website, the PowerPoint is available. So I probably should have put the link to the page in. I will, but we should put it in the description, but the link to our website where you could get the PowerPoint. It's a little bit tricky with YouTube Live, but sometimes it doesn't always work out where the slides are on the screen, David, but I agree. It's easier for me to look at it. That's why I don't have my glasses. But I will incorporate your thoughts. I appreciate that. And again, if people have questions or thoughts or ideas, like hit me up. I love to hear from people. I do this because I love to do it, but I do it for all of you. So if there are areas and topics that you want me to talk about, I'm happy to talk about it, right? I want to educate people. I want more people to know that the self-directed IRA world exists. It's out there, and it's a great, great, rewarding, tax-efficient way to invest. So thanks for everyone for watching. Thank you for everyone who submitted questions, especially David, who's submitted some really good questions. Otherwise, have an amazing rest of your day, and thanks for watching. Take care.